Hello everyone, welcome back to our channel where we dive deep into the world of real estate and investments. Today we are going to explore the rapidly evolving landscape of real estate investment trusts or REITs in India. Ever wondered about real estate investment trust that is REITs? Well, they are trusts established under Section 13A of the Income Tax Act, specifically designed to own or finance real estate. Now, REITs primarily deal with interest and rental income, which are taxed at the investor level. However, capital gains and other income are taxed at the REIT level. The Indian government has been making adjustments to regulations to make REITs more attractive to investors, aiming to bring liquidity to the real estate sector. So, if you're considering investing in real estate, certain REITs could be a viable option worth exploring. REITs are regulated by various laws and regulations, and the government has taken several steps to promote their growth and ensure transparency in the Indian real estate market. In India, the real estate sector has been a significant contributor to the country's economic growth, and the introduction of real estate investment trusts or REITs has opened up new avenues for investment in this sector. The primary legislation governing REITs in India is the Securities and Exchange Board of India, that is SEBI, and Real Estate Investment Trust Regulations 2014. These regulations provide a comprehensive framework for the registration, operation, and governance of REITs in the country. Some key aspects of these regulations include sponsor and manager requirements. SEBI mandates that REITs must have a sponsor and a manager. The sponsor is responsible for setting up the REIT and must hold a minimum of 25% of the total outstanding units of the REIT for a period of at least 3 years from the date of listing. The manager is responsible for the day to day operations and management of the REIT. Investment restrictions. REITs are required to invest at least 80% of their assets in completed and revenue generating real estate projects. They are also required to distribute at least 90% of their net distributable cash flows to unit holders. Third, listing and disclosure requirements. REITs are required to be listed on recognized stock exchanges in India, and they must comply with various disclosure and reporting requirements to ensure transparency and protect the interests of investors. In addition to the SEBI regulations, REITs in India are also governed by other laws and regulations such as the Companies Act 2013, the Income Tax Act 1961, and the Foreign Exchange Management Act of 1999. Now, let's talk about some significant changes introduced by the Indian government to accelerate the growth of REITs in the country. The Indian government has taken several measures to promote the growth of REITs in the country. In 2020, the Finance Act introduced several amendments to the Income Tax Act 1961 to provide a more favorable tax regime for REITs. These amendments include exemption from dividend distribution tax or DDT. REITs are now exempt from paying DDT on the dividends distributed to their unit holders. Second, tax transparency. REITs are now treated as pass through entities, meaning that the income earned by the REIT is taxed only in the hands of the unit holders and not at the REIT level. Third, tax incentives for sponsors. Sponsors of REITs are eligible for certain tax incentives, such as a concessional tax rate on capital gains and exemption from minimum alternate tax, that is MAT, on certain income streams. These tax incentives have made REITs more attractive to investors and have encouraged the listing of new REITs in the Indian market. One of the recent REITs listed on the Indian stock exchanges is the Mindspace Business Parks REIT, which was launched in 2020. The Mindspace REIT owns and operates a portfolio of high quality office parks and has a total leasable area of over 30 million square feet across Mumbai, Hyderabad, Pune, and Chennai. Now, let's take a closer look at the recent performance and strategic moves of Mindspace REIT in the current quarter. So, in this quarter, Mindspace REIT reported an interest of Rs 0.50 per unit, totaling Rs 29.7 crore, along with other income of Rs 0.001 per unit, totaling Rs 60 lakh. Ramesh Nair, the CEO of K. Raheja Corp Investment Managers, expressed satisfaction with a robust net operating income or NOI growth of 10.4% year on year, excluding one off items. The company achieved gross leasing of 0.45 million square feet in quarter 3 of fiscal year of 2024, with a cumulative leasing of 1.6 million square feet for the 9 months of fiscal year of 2024. Notably, the re-leasing spread for quarter 3 FY24 stood at 17.1% on zero point 0.4 million square feet of re-let area. In place rents also witnessed a 5.4% increase year on year, reaching Rs 68 per square foot per month. Furthermore, the company obtained board approval for the acquisition of a 42,000 square foot area in Commerce Zone Yerawada, Pune for Rs 410 million, while also initiating the divestment process for a vacant land parcel at Mindspace Pocharam in Hyderabad, spanning approximately 26 acres. Mindspace REIT's financial standing showed gross debt at Rs 6,800 crore, net debt at Rs 6,008.4 crore, net debt to market value at 21%, and a cost of debt at 7.8% per annum. Another notable REIT listed in India is the Embassy Office Parks REIT, which was launched in 2019. The Embassy REIT owns and operates a portfolio of high quality office parks and is one of the largest office REITs in Asia. In a recent news, Embassy Office Parks REIT is set to raise Rs 2,500 crore through equity via an institutional placement, partly funding the acquisition of a Rs 1,269 crore office park in Chennai. This strategic move not only expands their portfolio by 11%, positioning them as one of the largest global office REITs, but also marks their entry into the vibrant Chennai office market. The acquisition promises significant financial gains with a 2.9% accretion to fiscal year of 2024 net operating income and distribution per unit, bolstered by the asset's impressive occupancy rate and future development prospects. Additionally, the REIT plans to utilize the remaining funds to reduce portfolio leverage, providing flexibility for future growth. With a solid economic interest in lease revenues and asset management control, coupled with a transaction structured at a discount, Embassy REIT is poised for continued success, building on their previous acquisitions in Bengaluru. Let's talk about the latest advancements shaping India's REIT landscape, from the introduction of regulations promoting affordable housing REITs to tax reforms aimed at creating a more favorable environment for investors. Affordable housing REITs. In 2021, the Securities and Exchange Board of India, or SEBI, introduced new regulations to promote REITs focused on affordable housing projects. This move was aimed at attracting more investments into the affordable housing sector, which has been a priority for the government. These regulations provide a comprehensive framework for the registration, operation, and governance of such REITs, making it easier for investors to participate in this crucial sector. Tax reforms. The Indian government has been actively working to create a more favorable tax regime for REITs. In 2014, the Finance Act introduced a special tax regime taxing income from interest, dividends, and rentals unless specifically exempted. Then, in 2023, the government proposed taxing distributions by REITs and Infrastructure Investment Trust (InVITs) at marginal tax rates for unit holders. However, an amendment softened this, taxing only a portion known as a specified sum, determined after deducting the acquisition cost. Additionally, the government proposed taxing income distributed by business trusts like REITs in the form of debt, widening the tax base and bringing parity in taxation. Investor rights and growth. Investor rights have been a major focus in the REIT space. REITs are poised to benefit from interest rate cycles and diversification into asset classes like industrial, data centers, hospitality, healthcare, and education. One notable example in the Embassy Business Park REIT, which has an impressive 83% occupancy rate spread across major cities like Bengaluru, Pune, Mumbai, and NCR. India's REIT market has witnessed significant growth, distributing over Rs 15,500 crore and raising over Rs 25,500 crore in equity capital. Regulations mandate REITs to invest 80% in income producing properties, pay out 90% of net distributable cash flows semi annually, and maintain a debt to capitalization ratio of 49%. Small and medium REITs, that is SM REITs. In a significant development for India's real estate investment landscape, the Securities and Exchange Board of India issued amendments to the REIT Regulations 2014 last year. on November 25, 2023. These revisions paved the way for the establishment of Small and Medium Real Estate Investment Trust or SM REITs, marking a pivotal moment in the industry. Under the revised regulations, SM REITs were granted the ability to raise funds starting from Rs 50 crore, with a minimum of 200 investors required for unit issuance. This move aimed to democratize real estate investment, allowing a broader spectrum of investors to participate in the market. One of the key aspects of the amended regulations was the requirement that at least 95% of the assets held by SM REITs had to be fully developed and generating revenue. This ensured a higher level of stability and income generation for investors compared to larger REITs where the requirement was set at 80%. Additionally, the amendments imposed stricter guidelines on investment managers, mandating a net worth of at least Rs 20 crore for those setting up SM REITs. Furthermore, a minimum retention requirement of 5% of total outstanding units was enforced for a specified period, bolstering investor confidence in the schemes. The amendments were hailed as a positive step towards fostering the growth of the real estate investment market in India. They provided a regulated framework for fractional ownership, allowing individual investors to co own properties and participate in the sector's growth. With these regulatory changes, SEBI aimed to enhance transparency and investor protection, thereby attracting more capital into the real estate market. The amendments underscored SEBI's commitment to fostering a conducive environment for investment in India's burgeoning real estate sector. The expansion of the REIT sector includes the potential for retail REITs and diversification into logistics and hospitality, attracting both domestic and foreign investors due to the growth potential and consistent dividends. SEBI's chairperson even projects REITs, INVITs, and municipal bonds to rival India's equity markets in size in the next decade. In the fiscal year 2023 and 24, real estate investment trusts and infrastructure investment trust witnessed an extraordinary surge in fundraising, totaling a remarkable Rs 17,116 crore, marking a substantial 14-fold increase compared to the previous year. This surge is attributed to regulatory support and a concerted focus on infrastructure development, driving infrastructure investor confidence in these investment avenues. REITs comprising commercial real estate assets and INVITs featuring infrastructure assets like highways offer investors stable returns and capital appreciation. The success of initial public offerings or IPOs has spurred developers to explore the INVIT route for monetization, fueling a robust pipeline for investments. SEBI's regulatory enhancements, including reduced lot sizes and increased transparency, further bolstered investor interest in REITs and INVITs. With their underlying infrastructure assets and consistent distributions, INVITs particularly cater to investor demands for stable long term yields. Overall, this surge underscores the transformative potential of REITs and INVITs in reshaping the investment landscape and offering lucrative opportunities for investors. These exciting developments indicate promising growth, regulatory adherence, and investor protection in India's REIT market. It's an exciting time for real estate investors, and we can't wait to see what the future holds for this dynamic sector. Overall, the introduction of REITs in India has opened up new investment opportunities in the real estate sector and has provided investors with a more transparent and regulated way to invest in income generating real estate assets. The government's efforts to promote the growth of REITs and provide a more favorable tax regime have contributed to the success of REITs in the Indian market. However, it is important to note that the Indian real estate market is still relatively nascent and there are challenges that need to be addressed. These include issues related to land acquisition, project delays, and regulatory hurdles. Additionally, the success of REITs in India will depend on factors such as the availability of high quality real estate assets, the performance of the underlying real estate market, and the overall economic conditions in the country. As the Indian real estate sector continues to evolve and mature, it is expected that more REITs will be listed on the Indian stock exchanges, providing investors with a wider range of investment opportunities and contributing to the growth and development of the real estate sector in the country. While the enabling regulatory framework has now existed for a few years, as on 4th January there were only 4 REITs in India. This industry is thus at a nascent stage and needs to evolve. Thanks for watching and don't forget to like, share and subscribe for more updates on the world of real estate and investments. See you in the next video.